some of you may have heard the background, but kind of real quick. So as I keep emphasizing, I have skin in the game and this has been my life. It's not some game to me the way that I think it is for a lot of people on FinFoot, which is fine. But, I grew up in the business. My father was an immigrant, came from Egypt to the US, had no money in his pocket, fell in love with markets, found his way to Merrill Lynch, fell in love with technical analysis, ended up working with Bob Farrell, kind of this legendary technician in the late 80s, wrote 2 books on markets. I grew up seeing his ambition, seeing his passion, his love for markets, seeing his boisterousness, if that's a word, which I think I bring to Twitter as well. He started up an RIA in 1991. I grew up seeing that investment advisory firm. He is part of Split in the late 90s. He started a hedge fund. He had guys like Stanley Druckenmiller as clients in his hedge fund. I joined the family business. He passed in '08. Family business closed. I was not of age to take the business over back then. Had to kind of reinvent myself and my career post GFC. Started doing a lot of writing, getting a lot of market analysis, largely correct, prior to QE3. Now, for me, markets are one of the most interesting and challenging domains to focus a career on. And this goes for stocks, bonds, Bitcoin, anything. In the sense that no matter what anybody on FinTwit says, the reality is there's no clear link between effort and result when it comes to investing. It's not like if you spend an extra hour after having spent already thousands of hours that you're going to necessarily get better investment returns, because there's always a degree of randomness in markets. There's always a degree of luck. And oftentimes people confuse their own portfolio returns for skill when it may just be luck in the small sample. Now, I say that as somebody who believes in cycles, who believes that there's a lot more to luck in this game, both good and bad, and who has put up real capital to try to make it in an industry which, believe me, folks, it's not easy to be a fund manager when you're competing against Vanguard at 5 or 10 basis points, when you've got a bunch of strategies that are Me Too's that are just hugging the S&P. If you want to get assets, you got to perform. If you got to perform, you have to do something different. But doing something different means you're vulnerable to years like last year, right? Where your strategies just don't work in that cycle. So long-winded answer, but yeah, grew up in the business. I try to keep my Twitter feed entertaining, interesting, but there's a lot of real serious academic literature that goes behind everything that I say, believe it or not. And I will tell you unequivocally that it's not a slight on individuals, but it's a slight on the crowd. FinTwit and what you see on social media is oftentimes a contrarian sentiment indicator. And we'll get into it, but I think we're at a point now where the sentiment is so beyond absurd on the bullish side that it might be worth considering things turning around. And by the way, that's coming from the standpoint of somebody who was risk on this week. Yeah, no, so this is actually a really good discussion to go into. So first of all, by the way, just to be clear, I don't know where Matt Damon is, but if anybody in the audience does know where Matt Damon is, please let me know, because I've been trying to find him. Okay, so first of all, let me preface this by saying I'm not anti-crypto, I'm not anti-Bitcoin. Notice I differentiate the two. And what I am anti is anti-overconfident narratives. Okay, what I am anti is overconfidence, which leads to leverage, which leads to crashes. What I am anti is investing based on faith or emotion as opposed to real data. Okay, so to your question, I present all over the US at CFA chapters on these different research papers I put out. And I always make it a point to say that the best thing anybody can do, most people, is actually to go for the broker that has the highest commission per trade. Now, that sounds really weird, right? It's like, why would you want zero commission trading? Why wouldn't you want access? Okay. There are studies that show that investors that put their money to work into an S&P 500 mutual fund, which prices once a day, tend to have better returns than investors that invest in S&P 500 ETFs, which price second by second. They're both the S&P, but investor returns tend to be higher in a mutual fund structure than an ETF. Now, why is that? Because the ETF is priced second by second. So there's temptation to overtrade based on gut feeling, right? And history has shown time and time again, the number one reason people tend to not do well when it comes to investing is they overtrade. They churn their account based on the ease with which they can get in and out. They think stocks can go down. Oh, okay, I can always get back in later. Or if the stocks are going to go up, okay, I got to chase that and let me keep rotating around different individual stocks and miss the momentum in whatever's working in the here and now. So I do believe there's a big positive to the democratization of finance, that the ability with which more and more people have been turned on to investing and trading. I think, though, it's a detriment to themselves if you don't have barriers, right? Because the barriers are what keep people in the game to not overtrade. Now, the final thing I'll say is I want to see the blockchain, crypto space, Bitcoin space. I want to see all of that do well. I don't want to see the space do well because of uneducated speculation, right? It's okay to speculate. It's okay to be bullish. It's okay to be bearish. At least have something that you can test. At least have some basic foundation that's not based on, I'm sorry, with due respect, memes, right? And jokes. And in some cases, outright pure pump and dump. Like, that's not okay, right? That sucks in a lot of people into this business of investing, thinking that it's a game when it's a very serious endeavor. Well, I think you said it correctly. It's like, let the market decide. Listen, it's something like 7 years ago. I was presenting somewhere, and one of the audience members randomly asked me, what do you think about Bitcoin and decentralized finance and in general, the entire space? And I said, listen, it makes a ton of sense if you're an emerging economy and you don't have a banking system. It was basically, at the time, 7 years ago, the real buzzword was micropayments, right? Kind of microfinancing, with cell phone to cell phone payments that are being done by people in other countries that don't have, a place to actually deposit their hard-earned capital, right? So I am all for education. I'm all for people trying things. Again, I'm not all for people trying things without putting the time and effort in. And maybe this is me being the old man yelling at the cloud. It's not that I'm that old, but if you're going to learn something, learn it the right way. Learn it beyond just doing, but actually study, right? So you said it yourself. You start understanding the role of money because of Bitcoin. Great. Bitcoin was a catalyst for you and a way of trying to get out of the system. God bless. I encourage everybody to think like that, but also to consider in their thinking how much they want to risk in whatever expression of getting out of the system is, right? So, long-winded answer, but yes, I think there is no doubt that this is an unstoppable direction. I have my doubts about the idea that DeFi upends traditional finance entirely, and that even if it does, it would happen in our lifetimes. The other part that's being missed by a lot of people, I think, when they talk in those terms, is time frame. And last I checked, I thought we were supposed to have flying cars by now, or autonomous driving. And that's not a slight on Musk or anything, but the reality is shit takes time. It takes a lot longer than people think. And that's why sizing, I always use that line, how much you own matters a lot more than what you own. Sizing is the key to this. So when I was taking the CFA level 4 exam, there's a term in there that best describes everything, which is that the stock market is confusing as fuck right now. Okay, and you kind of just hit on some of those dynamics. Okay, let me provide context and set the record straight, because there's a lot of silliness that's happened on Twitter by either anonymous accounts or large accounts that, for whatever reason, are unable to read. I was very adamant saying there's a melt-up coming October 3rd last year. And I said that because at the time, the speed with which bond yields were rising, had that speed of yield rise continue, it would have been the end of the financial system. You would have had mortgage rates by November at 20%. If you were to extrapolate the speed that bonds were selling off and yields were rising. And you can't make money on the end of the world because nobody gets paid on it. So I put that tweet out, it was actually October 2nd, I said the end of the world is at hand. That's why stocks are about to have melt up. And I was an adamant son of a bitch saying we're in a melt up phase. That's it, we're in a melt up. December 2nd, I said there's a high risk of an imminent crash. Crash didn't happen. 5th worst December in history. I'll take it, going back to the Great Depression. Okay, it's about conditions, not the outcome. Okay, conditions were there. Still a nasty December. There was no Santa Claus rally last year. Then after the first week of January, it went back to melt up. Stayed that way throughout. I said March would be volatile. Yeah, the regional bank crisis, markets were still positive for March. And then I started saying early April that I think the third week of April is when you might have the setup for a correction. Now, a lot of people fixate on that. And I kept on saying, jokingly, not jokingly, that I'm going to be annoying as fuck if I'm right about that October third week type of time frame. Now, you didn't have to your point, you did not have a correction since then in the large cap averages. But the truth is you did have a lot of divergences. Small caps failed to participate. Commodities started breaking down. We saw what happened to the crypto space. Right? Bitcoin, everything largely peaked around then, at least for now, short term. We'll see longer term. Now, all that is in the context of a pre-election year. Okay, pre-election years, the third year in the presidential cycle tends to be the strongest historically. Okay, and that's why I said I think we're in a melt-up year, but it's going to be volatile. You're going to have corrections within that, just like other years. Right, so it can still be a positive year. Now, the thing is, as things have been progressing, the pre-election dynamic has not exactly played out according to script. Because to your point, there has been no breadth, right? So Barron's had a headline piece from someone else that did research that showed that small caps, up until probably today, I think they're positive for the year, small caps had never, at this point in a pre-election year, had negative returns. So there's something else that's happening. It's more than just the regional bank side. Lumber weakness suggests housing is going to be in trouble. Consumer discretionary stocks are weak. Retailer stocks are weak. So you've got this interesting dynamic where it's a tale of two very different markets. Now, the AI narrative, I think, is interesting because I think it's one of those here's the birdie type of things. No doubt, NVIDIA and the space has real demand. That's not at issue, right? So does Cisco, by the way, okay, at the peak in the NASDAQ bubble. The issue here is that there's a lot of narrative chasing around the next hot dot that people believe is going to overwhelm the world. Meanwhile, underlying dynamics still look pretty iffy. Now, on your point about, the rest of the year, I've made this argument a couple of times. Not to say that you have to have something exactly like 1987, but you have precedent in that 1987 was a pre-election year. 1987, you had the S&P up 38% at the peak. 1987, you had a crash with the October massacre. And then 1987, you had a Fed pivot. So to think that you can't have all that happen this year, when it already happened in history, to me, I think is where people get very tripped up. Now, the big question here is, what is the rotation that's most likely? Are we going to see a rotation from large caps to small caps? So a widening of breadths. Today was a very good day on the small cap side, right? Or are you going to see a rotation out of equities into treasuries, which should be consistent with the correction, which again, did not happen in large cap averages, but I keep going back to it wasn't a correction, it was divergence, right? I suspect it's going to be more into treasuries. Now, the question is the path, how it plays out, right? And I say that because you're in a seasonally weak period anyway. May to October tends to be weak for equities in general. I think a lot of people are betting on small caps recovering in a sustained way. Maybe they will, maybe they won't. I'm not so convinced. And I think that a lot of this AI money movement is a function of people being afraid to position into bonds because they don't think it's safe anymore given the way last year played out. So what do? They go into the large cap names which are crowded, which to me, by the way, is an interesting contrarian signal on bonds. Like the fact that everyone's so bullish on tech as the safe haven play actually makes me very bullish on treasuries, right? From a path sequencing perspective. But I don't know either, folks. Like anybody that tells you on FinTwit they know exactly what's going to happen, please fucking block them. You have to think of things in terms of conditions and sequences and paths. Everyone talks in terms of endpoint. The endpoint doesn't matter. It's about how you get to the endpoint. I am no better than anybody else. The only difference between me and everybody else is that I actually can prove somewhat from a testing perspective that certain areas have predictive power, like utilities, like treasuries, like lumber to gold, like moving averages, like the VIX at extremes. Everything else is largely noise. So it goes back to, it's the self-education process. Get involved in markets, but also be able to recognize bullshit from what's real. And at least I have skin in the game, but, beyond this period, I can prove with actual data that the stuff has predictive power. So long-winded answer, but bottom line is, you're right. It's a confusing market. A lot of people, I think, are being deceived in thinking that it is a traditional bull market. It is not. You've never had as much idiosyncratic risk in the S&P 500 like you do now. I put out that tweet. It's like 25% of the S&P is five stocks, driven by five stocks. The weighting is five stocks. Like that's never happened before. This is a diversified portfolio having company-specific risk is pretty wild when you actually think about it, and pretty dangerous. I find it interesting to think about the definition of bull and bear. Okay, so I get it. We trade nominal prices. So people say, well, the S&P is flat for the last year and a half, and NASDAQ's pushing. Okay, after inflation on a real basis, that's not true, right? Because inflation is eroding the nominal price. Here's the truth about definitions. You don't know if it's a bull or bear market until the prior drawdown is overtaken, meaning you have to make new highs, and you have to totally crawl out of the drawdown that happened last year, which was the October low in the S&P. So it's like when people say, oh, you're up 20%, so that's a bull market, or you're down 20%, that's a bear market. That's not true. It's where was the higher watermark? Like until you're out of that higher watermark, until you've actually blown past it, you cannot say with confidence that it's bullish or bearish. You don't know, except with hindsight. Now, for me, and this is so fun, I have to say it's utterly amazing to me. Because in January, I was saying, after that first week, I said melt up. And I said, I still think we're in a bear market in the context of that melt up. And nobody was countering me when I said that because everyone was still bearish. Now they're all countering me. They're all saying melt up and it's a new bull market. Okay. The reason, and maybe this is, me hoping, okay, because I have a bias like everybody else. My bias is I want to see volatility, not a bull market or bear market. I want to see both, right? I want to see the sequence. I want to pull it up and share it at the nest. The reason I keep saying I think we're still in a bear market, okay, aside from the fact that we haven't taken the new highs to the prior highs yet, is, okay, small caps not participating, retail is still at the pretty much the October low. But I'll share at the nest the chart that I've put out many times, which thankfully got like 6 million views, which really explains the hell I went through last year. Okay, so hopefully that shows up in a second. Let me just share that here. I'm going to retweet it as well. Okay, so this chart, if everybody can see it on top of the Twitter space, this is the most important chart to help people understand the environment that we've been in and where we might still be in. Top 20 biggest drawdowns for the S&P 500, going back to 1961. Biggest peak to trough declines in history. That's in gray in that chart, in that tweet. The purple is long duration treasuries, TLT, as your proxy. It's not my imagination. Okay. 10 out of the 20 biggest declines for the S&P, treasuries made you money. As the stock market is going down, treasuries countered as the safe haven risk off play. 9 out of 20 times treasuries lost, but they lost a lot less, like the 70s. The narrative that it's like the 70s is just not true from a sequencing perspective. The far right was what happened last year, which is what I called hell, where long duration treasuries went down more, had a bigger drawdown than equities in the top 20 drawdown for equities. People looking at that on Twitter, they say you should have seen that coming. That's because the Fed hiked rates. Bullshit. The Fed hiked rates 2 years after the drawdown in long duration treasuries began. The Fed does not own the bond market. The bond market owns the Fed. They say that everybody could have seen that stocks and bonds would lose money. Sure, that's the end point. 74% of the year last year, treasuries lost money using weekly data. 59% of the year, the S&P lost money on a weekly data basis, most since 1931. Wasn't that they both lost, it's the way they lost. The sequence, the path, which is all that matters. The assumption on the far right, which goes to your question about why am I still saying bear market, the assumption on the far right that treasuries fail to act as the safe haven is that the drawdown for stocks is over, meaning that we're locked in on those lows from last year. What if we're not? So if you break the lows from last year, it means we're still in a bear market. The gray, which is the S&P on the far right, goes down further because you broke the lows from October. And maybe in that case, the purple, which is treasuries, counter this time around. That flight to safety dynamic, which you saw briefly during the regional bank crisis, asserts. So if you look at that chart, I know everyone says this is like the 40s or like the 70s. I think this is going to play out in the fullness more like 1968 to 1970. Third from the left in that chart, you had treasuries down 14% during that equity drawdown and the S&P down 32%. So they both sucked, right? But treasuries still sucked a lot less. My whole contention around whether it's a bull market or bear market is I believe that the relationship of stocks to treasuries has to be righted, which, by the way, would happen if you have a recession, right? It's like what happens in recessions? Yields drop. What happens in a recession? Stocks drop. Everything I've been saying has been consistent, all relative to the way last year played out. And final thing I'll say, and I'm kind of talking a lot here. People keep forgetting that interest rates act with a lag, which is insane to me. The regional bank dynamic happened not because the Fed was hiking rates this year, because they were hiking rates last year. It happens with a delay. So nobody in this Twitter space can possibly tell me that there isn't a potential tail event out there because we have yet to price in interest rate hikes from months ago. We probably already over-tightened. Nobody wants to think of those terms, but you don't know except with hindsight. So my role and the way I see myself on Twitter and in this kind of FinTwit community, whatever you want to call it, is I try to be loud and aggressive purposely because it's a persona, right? On Twitter. I make that very clear. Anybody talks to me one-on-one, doing business, all this stuff, yeah, that's my professional self. This is what gets engagement. But the reality is, I hope to get people to think differently because if you're thinking like the crowd, you're not thinking. Which, by the way, sorry, and will not to interrupt, but I had brought up this scenario before as part of, I said I would not be surprised if the market hits new nominal highs. Nominal. But after inflation, you're still in a bear market. That's what I'm saying. People they're not understanding the real versus nominal discussion. Right. But in fairness, that's also really hard, right? I mean, it's like I get it, but it's like in practice, like somebody said to me, sent me a tweet saying, why don't you just play it with a trailing stop? It's like, well, if it was that easy, everybody would be rich. Like it does, but the other part of this, and this is why I also have a problem with the argument that you have sort of a sustained rotation out of the large into small. It's like narrative always follows price. So people forgot that the real narrative that matters is you have a lot of zombie companies, okay, which probably are not going to be able to roll over their debt and survive on higher rates, which are a lot of small cap companies, which are a lot of retailers. So you're right, by the way, on if you're going to do it, you should probably be very selective, because you could have the Russell 2000, for example, have ripper of a move like today. The question is, how sustainable is it when you have fundamentals, which at the end of the day, stock and company are different, but they will merge at some point, right? In terms of valuation. The question is, can those smaller cap companies on these higher rates roll over that leverage, and survive? And that's why I think this is that. It's funny because that was the correct narrative at the start of the year and at the end of last year, but somehow everybody forgot that now, because they're just looking at, the large to small ratio, which is back to the COVID crash levels, as I keep noting, maybe for good reason, which goes back to, you can be bullish and bearish at the same time, which I keep stressing. And this is what JC Perret said it correctly. It's like 99% of these FinTwit silly battles that people have can be resolved if people just outline their time frames on things, right? It's like, you can be bullish short term and bearish long term. You can be bearish short term and bullish long term. It's about the path. So, okay, just on the point about thinking about mechanics, never just one thing that drives movement. Okay, so poke fun at squiggly lines, right? Because I think a lot of people show these technical analysis patterns and charts and lines, and they look really great, but nobody ever backtests them to see if there's any predictive power, right? True technicians don't care what they're looking at. That they look only at price, right? It doesn't matter if it's oil, bonds, Dogecoin, whatever. Intermarket analysis, which is the school of thought that I focus on, says that what you're looking at matters. I'm going to answer your question in the context of this. What's sort of a classic intermarket relationship? It's the relationship of oil prices to bond yields. So when oil prices rise, typically bond yield rise. Bonds sell off, yield rises, right? And the reason is very clear. Oil is a form of cost push inflation. So as oil prices rise, inflation rises. As inflation rises, bondholders start saying, treasury holders start saying, I need more yield. I got to get compensated for that erosion of purchasing power. Now, the key thing is that it doesn't happen right away, meaning oil will move, then inflation expectations move, then bond yield move. So when did oil peak? June of last year. When did the 10-year treasury yield peak? Right? October of last year. So, and that's not a coincidence, right? So I'm trying to get to your question about the refill and how it affects bonds. The duration question will be a function of what else is happening around bonds at the time that they're doing that. So oil prices clearly are showing weakness, which is disinflationary. We should push yield prices lower. So that could counter any kind of new issuance of supply. That's why it's not as clear to me as to say, well, like I saw those stories, you're going to have this huge flow of T-bills that enter the marketplace. Okay, but if oil goes down to 40 or 30 a barrel, that's going to get soaked up pretty quickly, right? So it's nuanced, is my point. I don't have a full opinion on the mechanics of it, other than to say that there's a lot more to the story than just the mechanics of what the Treasury does, right? And again, sort of I'd argue what commodities are doing at the same time, and how that impacts the cost push side. The demand pull inflation side is intriguing, because I keep going back to retailer, consumer stocks. All of those areas look pretty weak. So if the stock market, in terms of consumer sensitive plays, is massively discounting anything that is based on consumer spending, if you don't have commodity cost push, you don't have demand pull, suddenly inflation breaks down pretty quickly. And if that happens, then they may not be able to issue enough bonds. By the way, on sentiment I shared in the space, the first time I actually said melt up, before I said every W needs a V, which was mid-August, was the day that CNBC flashed on TV, markets in turmoil. So speaking about sentiment, right? It's like, I use that line many times, opportunity always exists when the crowd thinks it knows an unknowable future. So the moment that everyone gets hyped up one way or the other is typically a sentiment tell. And the media is very good at playing that off, because that's how they get ratings, right? And that's their incentive. But as far as what I do, I believe that the behavior of utilities against the market is the ultimate way of telling you sentiment. I believe that lumber gold is the ultimate way to tell you about sentiment. Same thing with treasuries. So rules-based mechanical, this is something which, again, I kind of ranted on this a little bit. People would rather follow large anonymous accounts that sound smart when you don't know if they have skin in the game. Folks, to be an entrepreneur in the fund business is one of the hardest, most brutal, and most rewarding, if you get it right, types of paths to take. It takes, it's at least 250,000 or so to bring a fund to market. And it's those people that tend to not have skin in the game that tend to be also the loudest about the market's trend. Now, I've seen this too many times to count. I can't prove it quantitatively, but it really is true. When you get people vitriolically attacking and insulting and poking fun at a particular view when the market is going against that view, that tends to be a turning point. That's more than just Twitter. I used to be one of MarketWatch.com's top writers. For 3 years, from late 2012 to 2016, I was one of their top writers. I could tell whenever I would do a writing that I would be right based on the comments section of those articles I wrote, where people would outright insult me. They weren't providing counter analysis. They were outright insulting me personally, right? And I've used that line many times before. You know you're right when the counter argument is an insult. We're there now again. Keeps happening. It happened during the October low. It happened in December. It happened when I said melt up again after the first week of January. It happened in March when I said I don't think this is the credit event during the regional bank run-up. It's even happening somewhat now. People are like, oh, what happened to your third week of April call? It's not a call, it's conditions. And to deny the fact that breadth and everything started diverging starting the third week of April is silly, as people don't provide their own counter analysis. Today was really interesting to me. Again, as somebody who's been risk on, right? Today is really interesting because there's a certain degree of real ugliness that comes out of people at major turning points. I see it now from the bull side, just like I saw it from the bear side in October. I can't prove it. Maybe it's wrong this time. Maybe the bulls are going to be fully right and keep melting up. But when you see overconfidence by the crowd, you have to be really careful, right? But this is more just me putting a spotlight on what I have observed time and time again, that the crowd is right on average, but wrong at the extreme. And the crowd is always loudest at the extremes. So I think with hindsight, it was spot on that stocks and bonds would fall together. What was surprising was how they fell together. And I keep going back to, it's not about the endpoint, but the dance in between. That was the surprise for last year. You know, I put a tweet out, and I still smile when I think about it, because I'm actually a big fan of Nassim Taleb's. And I put a tweet out in June. And by the way, for those that are in the audience, I don't mind being wrong and being told I'm wrong as long as I'm legitimately wrong, and as long as my process is still right. That's the key thing. You just said it correctly. It's like, you look back on the outcome, right? What'd you get right or what's wrong? The single roll of the die is not how you determine if something's right or wrong, right? It's the process. It's the multiple roll of the die. It's the probabilities, not the small sample that we all live in. Okay, so in June or July, I think it was June, I said, the black swan wasn't that stock fell, wasn't that bonds fell, it was that they both fell together. And Taleb retweeted with a comment saying no, and all kinds of people started attacking me saying, oh, imagine this guy thinking stocks and bonds going down, couldn't happen. And admittedly, I probably didn't word the tweet correctly, but I keep going back to that point that it wasn't that stocks and bonds went down that was the surprise. It was that the flight to safety trade failed because of the weekly interaction of stocks to treasuries. You could have had stocks go down in the second half of the year and bonds go down in the first half of the year. It's that they went down in this very correlated week after week way, which had never happened before in history, which is an outlier, right? And that's not debatable. People say, oh, it was an outlier. I have the data, they don't. So that's one thing. I think the other thing is that's been a surprise is what's happening right now this year. Again, because I was very loud and bullish saying melt up, start of the year. And the fact that you had this tremendous divergence in small caps and large caps is surprising compared to history in pre-election years. Maybe it resolves itself, right? But markets are funny, right? You can be both right and wrong at the same time based on your opportunity set. And markets are the only domain where you can be wrong and lose and make money, or right and lose money, right? Depending upon the timing of things. So I think those have been, for me, the most surprising. Now, having said that, all that's with hindsight. It's always easy to cherry pick and argue that something was seen or not seen when you have the full visibility of the past. But I do think that what's missed by a lot of people on FinTwit is the historical data on the past behavior as opposed to, is it a bull market or bear market? So the first half of this Twitter space was me basically just saying on and on, where the fuck is Matt Damon and NVIDIA's fucked? I'm going to give you the recap of everything that I said the first half. But by the way, that is directly related to your question, which I touched on a little bit, but let's expand on this. Russell 2000 being up 5% year to date. That's almost all because of today. And a big chunk of that was just probably today's performance. But also on a real return basis, that's still flat, right? I mean, after inflation is probably negative on a real return basis. And I keep going back to the script of the pre-election year on small caps is not playing out according to history. So something is different this time around. This is not open to debate because that's facts. That's in history. Now, I go back to, can small caps play catch up to large caps? Sure. No doubt. I don't think it happens because seasonality is against it, at least now. I could be wrong. And I put a piece on Seeking Alpha basically saying that what's happened the last few weeks has been interesting. You had essentially capitulation in defensive sectors the last 3 weeks. Meaning, if you look at the relative strength of utilities, staples, healthcare, the three low beta parts of the stock market that tend to be the real places to hide massive underperformance in a really sharp way, almost like capitulation, like you'd see on a price chart, which would say you're probably at a low as people just dump out of defensiveness because they've given up on the bear argument, which is probably why it starts to reassert. So the fact that you've had what looks like capitulation the last several weeks in defensive sectors would suggest that on a rolling basis, they may have bottomed and then you're going to back to kind of a risk-off sentiment play in the next few weeks, which is why I'm estimating, I think mid-June, you could kind of go back to a high-risk period. Got May to October, sell may go away type of period. Not necessarily negative for stocks, but not necessarily positive. Makes it, I think, hard for small caps to run. You still have a hell of a lot of weakness in lumber, and people seemingly forgot that Home Depot earnings, suggested that, lumber was falling off a cliff because guess what? Home construction is probably about to fall off a cliff. I get it. People say, look at home builder stocks are not predictive. Lumber is. I can prove that. I have a whole paper on that. And on the point about treasuries, again, selfishly, I want to see that flight to safety dynamic. When I talk about treasuries, the whole Phoenix Rising idea, I'm not talking about owning treasuries to maturity, right? What I'm talking about is a very well documented phenomenon that when you have these high volatility sequences, meaning, big ups, big downs in equities, there's a flight to safety trade. Money for a moment in time goes into, in quotes, safer, less volatile assets, which would be AAA bonds, utilities, staples, healthcare, because they're, need sectors, not want. And then ultimately duration treasuries. I think treasuries are really interesting here because nobody seems to be of the mindset that they can ever outperform equities again, at least even for a few weeks, even for a month and a half, which is what would happen probably in a correction. So I lean more towards the possibility that treasury, the rotation is not from large to small, but from equities to treasuries. But it's my suspicion that the real contrarian trade isn't small caps, it's really treasuries. For now, it could be small caps after that, which is why I go back to sequence, path. You can have both. The question is, what's the timing? I think it's a selective mania, but we are in a mania, right? And the thing with this stuff is that there's always mean reversion in markets, right? It's like, I've used that analogy before that in this business, you can never guarantee anything, right? That's a hell no from a compliance perspective. The only thing that you can, is as close to a guarantee as possible in market is mean reversion, right? Now, we can debate where the mean is. The mean's always changing, but mean reversion is the one constant in markets and in life. And I always go back, mean reversion is a concept that's as old as the Bible, right? He who is first shall be last, and last first is mean reversion. So I haven't looked recently at the Qs against tips and, the other equity risk premium, but I can obviously imagine it. That sounds like the setup for a mean reversion, which would be risk off, which I keep going back to. I think it's going to be more rotation out of equities into treasuries for a moment in time than from large to small. But I could be totally wrong. And by the way, folks, it's okay. Stop going after people that are in quotes wrong in a moment in time. Provide analysis. Provide something that's thoughtful. You don't grow by attacking. You grow by collaborating. Yeah, I appreciate it. And obviously, besides Twitter, I've got podcasts, which are from the Lead Lag Live spaces that I do on YouTube, Spotify. You asked a good question, and I always go back to there are no gurus, only cycles, and that just doesn't apply to markets, but that just applies to life. There's a chapter in my father's book where he quotes Ecclesiastes. Okay, time for everything, right? Time for everything. Season for every activity under the heavens. A time to be born, a time to die. A time to plant, a time to uproot. Time to kill, a time to heal. A time to weep, and a time to laugh. I'm not going to say the whole thing, but my point is that there are cycles. There are higher lows and lower lows in life, but nobody can predict the future, which means you don't know where your own cycle is going to be in terms of advancement or non-advancement. Just keep positive. It's not an easy life. And I think, I tend to be more of the mindset that life is misery with occasional periods of joy and happiness. But you've got to just kind of keep pushing forward because if you believe, as I do, that nobody can predict the future, that means you don't know if tomorrow's going to be better or worse. So take it as it comes.